Hey guys, welcome back to the Max Spence Business Podcast. Today I'm really excited for this episode, but before I jump into it, if you guys like the content I'm putting out, the people that I'm interviewing, please like, subscribe, leave a review. It helps out a lot with the podcast and also the people that I'm having on the show and, growing their brand as well. So without further ado, today's guest, is Michael Kharlab. So he's the managing director of CFP Group, a real estate investment firm. He is also a real estate educator as well. It's great having you on the show, Michael.
Pleasure to be here. Thank you.
Awesome. So why don't we jump in with, an intro about who you are for maybe people that don't know who you are and what you do. How did you get into real estate and what's sort of your background?
Okay. Yeah, absolutely. So I come from the corporate world, from the IT. I spent 20 years as an IT professional. About 10 years ago, I had a friend coming to me to visit, and he told me that he bought a condo in Miami. It was 2010. I looked into Miami. I know the situation was bad after the crash of 2008. I didn't know it was that bad. So the prices dropped significantly, and I started looking into that. And approximately 2 months after, I was on a plane with my other friend to Florida to buy our first property. So I figured out if you buy something for 50 cents on the dollar, without even knowing much about real estate, you cannot be that wrong. So we bought our property that trip. Then we bought another one. And then I was introduced, after a couple of years, I was introduced to real estate educational program. The company was affiliated with Robert Kiyosaki's Digital Education. So I decided to become a student and decided going forward that it's going to be a passion of mine and a way to make money and impact other people's lives. So I did several courses, had a mentor, and then I started doing different strategies in real estate, started working with investors, and eventually in 2017 I was laid off by the same company second time, and I decided not to come back to the corporate world, so I became a full-time real estate investor.
Yeah,
so in essence, that's my story.
Yeah, that's incredible. And that's what and like a lot of like real estate investors that I sort of see that I've interviewed, that's sort of their story. They went into the corporate world and then but they wanted something more. They weren't being fully fulfilled. And then they found out about real estate and they found out, what they could achieve with real estate. They start buying a condo or a single family home and they just build it. And now they're doing, stuff such as yourself, which is absolutely crazy, which we'll touch on more on the podcast. But I want to get to sort of the beginning of how you actually sort of made the transition into real estate. What did you start first buying? Like, was it condos? Was it single family homes? Was it small multifamily, like a triplex, a duplex? Or did you just scale into it really easily and just go from like, a condo, a single family home, and then like a 12 unit or a new construction or something?
Yeah, so I started with the simple condo purchases in Florida. And the reason we went with condos and not single family homes, because in Florida, there's very expensive insurance that you need to buy for hurricanes. So, and at that time, also the condo association would interview the tenants. So it was another level of protection for us, make sure we get good tenants. So I did two transactions like that. The third one, we partnered up with two more people. We bought a triplex, also in Florida. So single family residential, that was the beginning. Then I did the real estate educational classes, and I started doing rent to owns. I partnered up with another company in Toronto, in GTA, that was very successful. So I found that I'm good at working with people, explaining the opportunities, explaining the deals. So after consulting with my mentor, I said, you need to be working with investors. So that's what I started doing. So started doing different partnerships in different areas with people who would operate, and I would bring investors to them. So I've done about 15 rent loans, started doing some purchases in the United States, and let's say around 2014 to 16, I was doing secondary legal suites in Ontario. Just you take a home, you add a second suite. Normally it's going to be basement, but legal is a core word here, and you get two incomes. And then after leaving the corporate world, it allowed me more time. So then we shifted to multifamily new construction. So it's more complex. the bigger rewards, and you can work with more investors at the same time.
Yeah, and that's awesome. So with that, like when this became your full-time career, you already had like a small portfolio of real estate deals, right? And then from that point
Yep.
on, then you started with the new construction. What sort of piqued your interest in going into new construction instead of just continuing to do like the single family sort of route and just accumulating single family homes or like in that sort of general sort of process?
Okay, yeah, so good question. What happened in the, I don't know where majority of your listeners are from, but in Ontario and the province we believe you and I live, especially in Toronto was booming, let's say from 2010 to 2015, 16. And 2016, the prices went up so much that the government decided to interfere in April of 2017. And when the government interferes, normally it impacts the market or the real estate, whatever they interfere. So there was an impact on real estate market in Ontario. So we decided to shift to United States, and it just happened to be that we decided to be in Arizona, which was our market of choice. And I was introduced to people who were doing larger projects, but were looking capital. So we built a model where we take a local operator that works on projects from start to finish, and we become as financial partners and consultants and what we call it co-developers. So it was a combination of factors. Ontario became way too expensive for our liking, and you couldn't do the deals with the returns that we can do in the United States, especially in a growing state like Arizona. So it was a transition for me. It was at the same time as I was living the corporate world. It was in March in 2017. In April, the government came with the new legislations. And in summer 2017, we decided to start working on first projects in Arizona. So it was just a shift that happened. Good timing, probably.
Yeah, true. So with that, like because I've had somebody else on the podcast that does the exact same thing, that they find investors in Canada that are looking to get better returns than what they can find in their local markets, and then they partner them with like you said, a local operator that has a track record of maybe development or multifamily or whatever they do. And then they manage the project. They be the money side. They bring the money in to fund the project, and then they give that returns to their investors once the project is either sold, or unless it's like a buy and hold, and it's just accumulating pretty much like dividends just coming out of the property every month or every quarter, however they decided to pay it out. So with that, looking at like from your experience, looking at the Canadian market and looking at the U.S. market, and I hear a lot from investors that saying like U.S. market, you always get better returns, but there has to be some sort of perks to the Canadian market. And I sort of hear from other investors, I don't know if this is sort of true, this is just sort of what I've looked into a bit from reading a few posts about it, is that the Canadian market is more stable. The returns aren't going to be as good as the U.S. market. You can still find good returns, but it's a lot easier to find better returns in the U.S. market. But a lot of people look to the Canadian market as a more stable market over the long term. And what are your sort of thoughts on this with like, the Canadian real estate market and the U.S. Real estate market, and what's been your experience in those situations?
Yeah, so I'd say it's completely different market. So in Canada, we depend on immigration a lot, and therefore the real estate prices are going up. In the United States, there's two types of markets. There is what we call linear and non-linear. And I'll start with linear. Linear, it's typically going to be a Midwest, somewhere in the middle of the United States, not on the Pacific coast, not on the Atlantic coast. So you can buy properties for very, very cheap. So for example, if you go to Ohio or Indiana, you can buy properties, let's say, for $70,000. Normally, you would rent those properties for, there's something called rule of 1%. So if you buy something for $70,000, you can rent it probably around $700 a month, meaning you're going to get a very good positive cash flow. The downside of that is that those properties typically do not grow. They do not appreciate. So all you get is a cash flow. With that being said, the point of entry into real estate is much lower. The second type of market is what we call non-linear. So those markets grow a lot during good times, but they fall a lot too when something happens. So Look at Miami, Las Vegas, right? Even New York probably. So you need to know how to place those markets to adjust your strategy. From the pricing point, there's two big cities that attract most immigrants, which is Toronto and Vancouver. Those cities in Canada became very, very pricey. So you cannot get a cash flow positive deal pretty much anywhere in Toronto or in Vancouver. And you need to start shifting outside. So probably today you need to drive, let's say, up to 2 hours from Toronto to get a decent return in your capital. So for people who live in Canada, it's a mentality of people. They want to drive by the property, to look, maybe to touch it, say it's mine. And you do not need to cross the border. So it's personal choice of people. Either you go and drive 2 hours, or you go on plane and fly 2 hours, right? But if you fly and you can get much better returns, I'd probably fly. The other thing is that in Canada, for some strategies, you can use RSPs, right? The registered funds or TFSAs. We just did a project that we're selling probably 3 weeks from now. And we were able to structure the deal that the investors could use the RSP money. So basically, they're going to get the returns tax-free. Versus if you're Canadian doing deals in the United States, it has to be cash. So there's pros and cons for everything, and it's just a personal choice of every investor. We just find that the returns that people can get in the United States in growing markets such as Arizona, it's very, very hard to do in Canada.
Yeah, and that's what having the previous gentleman on. They were just in the process of, I believe, of structuring that, the RSPs, and they were just in the process of actually getting to that sort of next level of structuring that for investors. I sort of want to talk now when you the growing markets like Arizona that you guys have picked, and also Miami. What's your process when you go into when you made the jump into the US market? What's your process to analyze these markets, right? Like you're looking for probably job employment,
Yes.
big anchors for, companies that are there. I mean, maybe Fortune 500 or whatever, diversity in the industries, or what are the things are you sort of looking at? And where can investors, let's say somebody who's maybe in Canada and they have a couple properties and they have $150,000 or $200,000 and they want to throw it into the invested into the U.S. market, what would be your recommended process to sort of analyze a new market?
So very, very good question, Max, and you actually touched on that. So when you analyze the market, you need to look at the macroeconomics, and then you start drilling down. So for example, if you look into Arizona, you look at the situation in the state, what's happening on the state level, then you look at the city, and then you decide which neighborhood you want to work in. So when we looked at Arizona in 2017, the economy was firing on all cylinders. There was a migration of people from other states. So migration means people move to the state within the country. Unlike Canada, where there's a lot of immigration, people coming to Canada from all other places in the world. So in Arizona, there was about 10,000 people coming every month. And every person that comes typically creates between 2 to 4 new jobs, meaning there's a new job creation. Also students, many students were coming to Arizona. Arizona is known as a student university of the United States. The retirees, right? People want to move to the sunny states. Many people move to Florida, but anyone on the west side, actually, they go to Arizona. And the snowbirds, people looking for the second home or vacation. So this is what we look like. And the last one is the affordability of the real estate there. So Phoenix is the fastest growing city in the United States, but it's what we call tier 2 city. Tier 1 cities are New York, Chicago, Miami, Los Angeles. And in Phoenix, we know they're not going to be financial capital of the world, for example, but there are some good companies that headquarters there. And many companies, let's say, I'll just give an example from Silicon Valley, started shifting the secondary positions to states like Arizona or Texas. So if an engineer is making $200,000 in California, the same engineer can make 120 in a year, let's say in Arizona, but the level of his lifestyle would not go down because the prices are cheaper. So many companies started opening secondary offices in Texas and Arizona, and that also led to the growth. So that's on the state level. Then you decide on the city that you want work, and then the neighborhood. So in the United States, unlike Canada, typically you get the hoods, what we call them, right? And they would be located normally on the south of the city. So if you look Chicago, South Chicago is not the best place. South Atlanta. So you want to be in the neighborhood, especially for us. We normally don't work in the what we call C or D class environments. We work where good working people live. All people are good, but the same people work. They have no problem paying rent, have stable income, and that's our the market niche.
Yeah, yeah, and those are all very very good pieces of advice of how you actually go into and analyze a market, and then you start going forward with it. So I wanted to sort of touch on that. Was you said something really interesting, is that the majority of markets you looked at, like Chicago, with like Phoenix, and the southern end of the market is more like, let's say, rougher, or is more C and D. From your experience, do you know why why that is with the city? Is it just like how it was sort of built out, or is there is it more industrial, or what sort of characteristics make up the more south side of a city?
To be honest, I don't know why. It's just something I found out, and it's the way you look. Like, take a look at Chicago, take a look at Atlanta, take a look at Dallas, and even in Phoenix, it's not that big of a difference, but it's still, I don't know why that happens. But it's totally different in US compared to Canada. In Canada, we might have bad areas within the city, but they're not as big. So honestly, I don't know why.
Yeah, true. Yeah, it was just something that came up, and I thought was pretty interesting, was just how the cities were built out and how they were sort of made from different economic standpoints. So now going on to,
Yeah.
I know we touched on this before actually starting the podcast, was you guys are starting a new strategy for real estate investing, and that's built to rent, right? I know from your website,
Yes.
you guys have done some pretty big built to rent communities. Can you actually touch on that, how you actually got into that? How did you sort of see that sort of new strategy? And then how did you actually execute that process to start, getting the returns that you guys wanted?
Yeah. So it's not something new per se. So in the United States, renting is popular, and it always has been. In Canada, it's a little bit less, but in the United States, typical ratio was 60% people own and 40% people rent. Two things happened. Number one, in 2008, there was a big crash, and millennials saw that their parents lost their homes. And some of them said, well, I don't want to get into that, I don't mind renting. And I don't want to own and something that one day goes down in value, and then you lose your home, and you lose the money to pay for the mortgage. So the ratio of renters actually now increased because millennials think a little bit different. That's number one. Number two, most of the rental communities are vertical built, meaning it's apartment complexes, sometimes they high rises, sometimes 3-4 stories. The new shift we're talking about, it's called build for rent. It's what we call horizontal construction. It's 1-story homes, and we're targeting premium renters. So out of the 100% of renters population, there's 10% who are very well compensated for what they do in life. They just don't want to buy for their own reason. So they're okay paying more for the rent, but they want to live in a rental community. So what we do is start building rental communities that are not vertical built. So basically it's going to be homes or semi-detached. And let's say if you go to in Florida especially, there's so many gated communities that were built, but those communities were built to sell. We're doing the same, just to rent. And it's very, very popular trend today. And especially with the COVID environment now, many people want to avoid common areas. So many people want to move out from the buildings where there is the elevators or the halls. And if they're able to afford, they want to live in a house where there is, less contact with other people. So it's a shift today, especially in markets like Arizona and Texas. And there's huge demand for those communities. They rent out like hotcakes. There's started several years ago, and it's very, very popular. So you build a community, could be different size, right? So I know you mentioned 400. It's one of the largest that we started working on, but it could be much smaller. And it's very popular, especially when today, let's say in Arizona, people move from California. For the first year or two, even if they want to buy, they typically rent and they buy. So there's no problem affording because they come from a state with way more expensive state.
Yeah, yeah, 100, yeah, and that's a very good point, right? Like when somebody first comes in, if there's a lot of like not immigration, but the other word you used, uh, that when people come into that market, right, they're not going to buy a home just right away because they don't know the market, they don't know what area they want to live in, so they'll probably most likely rent somewhere for a year or two and then go and proceed to buy something. But even then, some people, how things have switched, people might not even want to buy anymore. But the interesting thing that you actually talked about, and I talked about I talked about it with somebody else on the show, was that a lot of people are moving to more of these residential markets, and I see it a lot in Ottawa. That people residential house prices in outside of like downtown Ottawa. Like for our market, for example, like we have the Glebe and other things like that, where houses are very expensive, but prices that are in the outside of it are going up like crazy just because people are not wanting to live, like you were saying, in the apartment buildings, renting those types of units where there's like hallways and all that sort of stuff. So diving into a deeper level of this conversation. So how does it sort of work? Like, when you're looking at a piece of land, you probably have to rezone it, or if it's already zoned, maybe another developer's already rezoned it and you just buy it from them. What's that sort of process look like? Are you guys, are you guys buying land that's already, vacant, or are you doing like an infill development?
We do both. Actually, we started with the infill development in 2017, so we participated in several projects that we exited. Two projects we exited last year, and the third one we're actually exiting in December. So the first one was 16 units, and then we did 14 units. Now we're exiting from 56. So those were infill, so vacant land, or there's something on the land that needs to be demolished, but it's in the middle of the city. We also did the land development. We've got one project just south of Phoenix, in a city called Maricopa. It's a larger land. The city, there's huge demand for this huge shortage of the rental units. So we just bought the land, and we were finishing the rezoning process, getting all the permits, and dividing the land into small parcels. So one parcel we're going to keep to ourselves to do a build for rent community. The others we're selling to other builders. So we're doing both. And normally our model is that the developer or the co-developer, the partner that we're going to work with, comes to us with an idea, with the project. We do analysis together, and then whether it's a go or no go from our side. So because we're in Toronto and the projects are remote, it's very important that we've got a trusted partner who's local, who can go to the site on a daily basis, who can operate it over there. So we'll look at people first and project second.
Yeah, and that's very interesting for people that maybe don't know about this. It's literally like you're going out and you're choosing pretty much a real estate agent, but in this instance, it's a real estate developer, and you're interviewing a lot of different real estate developers for their track records, and seeing what they've done. And then, if let's say they say, hey, we're looking at, doing like the 400 units or 60 units or 50 units in this sort of area, then you go in and you analyze it, you look at like, what are the returns going to be? Is there demand for it? And then you guys have the money, right? And you pair those together, and then you start developing the property. So you guys aren't directly managing the everyday construction of it. That's handled by the developer. But in your instance, what would sort of your everyday sort of interaction be? Would that be like sort of a phone calls to see what stages they're at? Other things. For my example, I don't have like any experience in this, so I'm just interested to sort of hear about what's sort of like the day in the life of running one of those operations.
Yeah. So in our company, basically, we there's just two of us. We're small, but we're efficient. There's some help, but there's basically two-person shop, and my role is more working with investors. And on the marketing side, you know, like what I'm doing right now, for example, right, being interviewed by you. My partner does more of operational side, so negotiations with developers, analysis of the projects. We do daily communication with all partners, development partners, because we're partners in the project, right? We do not hire them; we become partners. So there are, you know, decisions we need to make together. So that's day-to-day operation. When out of the COVID times, we typically go there, I'd say between 8 to 12 times a year between two of us. So we're not there on a daily basis, but we're there almost every month. So it's very important. Communication to investors, very important. You know, sending pictures, status of the projects. We're in constant communication with investors who basically they trust us, right?
Yeah.
Give us money, and we always invite them to come and visit, but most people would never do it, right? It's just more convenient to trust somebody, and if it works, they would follow. So what I do, my day is communication with investors, and it takes a lot of time because people want understanding of the deal and answers to questions. I do a lot of education. Just if people invest with us or not doesn't matter to me. I try to help. This is how I try to impact positively the other people. So education is important, and obviously working with partners on existing and new deals. And it's like rinse and repeat. You do one deal, you see it's working, why not to do it again? So build long-term relationship with investors and with partners.
Yeah. And the thing I really like about this and how you guys have built your company is that you guys complement, you complement each other, right? Like you're more of the people, the investors side, the marketing, all that sort of side of the business. And your other partner is more of like the numbers and the accounting and all that sort of side of the business, right? And for somebody who's maybe, I know for my circumstance and maybe other people's circumstance, let's say they actually don't want to do the people side of it and they prefer the numbers. Well, hey, you can find somebody like you did, partner with them, and somebody such as yourself can actually be the people side. Or let's say if they're really good with people and they're really good with networking investors and all, and they love doing that and that's what they're great at, they can find somebody else who's really good at the number side. And that's the awesome thing about building companies and stuff, is that you don't have to be the one-stop shop for everything, right? You can partner out and you can have different people inside your company that do different things, and then that leaves you to do what you really like to do, which is talking to investors, educating people and bringing new investors in. So to talk on that with more detail, so how do you go about, let's say, what are your sort of like prospecting or new sources for bringing in new investors to the company? How, like, I know that you have a real estate group in like a real estate club in Toronto. So how do you sort of go about, bringing in new investors or new capital to the firm to then for that to get reinvested and bring those returns to the investors?
Yeah, so with us, it's pretty much, we don't advertise. First of all, it's not allowed. When there's a need to advertise, there are some certain rules, but we're never going to to do anything about it. So we basically a referral company. So there's so many people working with us, and they refer other people to us. This is how it's growing. We've got close to 100 investors today. So people find us. Sometimes people find us through social media or through the website, but in, I'd say 90% of the cases, it's somebody who's been working with us and they're referring to other people. So we believe in creating long-term relationships. There are many business models in this world. There are companies just bring other investors to partners for a transaction fee. We stay in the project till the end. We're part of the project. We partner in the project. So yeah, so it's a referral, and most of the people, probably vast majority of them, they move from one project to another with us. So this is how we're growing.
Oh, okay, awesome. Yeah, so you guys focus on the relationships, and then it's like word of mouth, right? Like once you've proven what you guys are capable of doing, and the returns that you get for your investors, then that investor, you know, maybe tells friends and family or somebody at work, and they're like, hey, you know, this is what I'm doing. And that adds to another person that comes into your circle. And yeah, I actually forgot about that, is that with you can't actively prospect people to invest into your deals, right? Because it's against, I guess like, I don't know what the law would be called, but it's against Canadian law that you can't just go out and start saying, like, handing out leaflets to people saying, hey, you want to invest in this deal? You want to invest in this deal? So actually now moving.
You see it a lot on the social media though. So many people still do it. We prefer not to to deal with the lawmakers.
Yeah. Yeah, it's sort of that gray area, right? And I think how they do it is not from a perspective of like, hey, you know, invest in this deal. It's more like, hey, this is what we're doing, this is what we've done, sort of thing. Like, that's, I think they're in that sort of gray area of being like, you know, they're not actively saying to somebody, hey, come invest with us. It's more like, hey, this is what we're doing. You know, if you're interested, maybe
you'll be surprised.
Yeah.
Things that I see on the Facebook and LinkedIn.
Yeah. So I now want to talk about pretty much. So when you guys went into those new markets, you started the build to rent, all that sort of stuff. I know that you also do mortgages. So with that, is that sort of like, do you guys have like, is it a mortgage fund that you're using to actually invest into these projects, or is it like syndication, or how is it sort of like working to get those investors, the funds, over to the U.S. market?
Yeah, so it's nothing to do with that. We're one-stop shop, investing shop. So if somebody comes to us and let's say they got equity in the properties they got in Canada, they want to take some money out and to invest with us, we would help and assist doing that transaction. So we both mortgage licensed, and my partner also has a realtor license in Ontario. It's more of an additional service to our investors. We're not a mortgage house. We're a real estate investment company that provides full service to our investors. So you will not see, you know, my face advertising the mortgage services, you know, on the bus stops, on the benches, or anywhere else. Just additional service we do for our investors. But yes, we were fully licensed mortgage.
Okay. So that's just an extra part, but you guys focus heavily more on the investing side and bringing
the investing side. Yeah, there's two ways to invest in projects like ours. The first, and it depends how the company structures the project. The first option is what we call being equity partner. So basically get shares or units of the company that owns the project. The second way is to lend money to the project. So in that case, the person becomes a bank, and with, you mentioned syndication. So there's two ways to lend. Basically, what I call direct lending is that one person needs money, and you just lend to that person. So it's one-to-one transaction facilitated by the mortgage broker, but it's one-to-one. Syndication means that two or more people get together and lend money to somebody or to the project. So it's also doable.
Oh, okay. Yeah. So like, let's say for a developer that was saying like they need, you know, 20, I don't know, like, let's say they need 20 or 30% for the down payment, right? And they would go out and raise that money, and they would go to maybe you guys, and, you know, you guys would either, you know, give them a loan for it, let's say a year loan or a 2-year loan, or however you guys sort of structure that. Or you would actually be the other hand of like, you know, actually investing into that, investing into that project with them for like the long term.
Yeah. So you got it right. So some projects are only equity based. People become partners in the project. In some cases, it's a combination of equity. It's what we call mezzanine debt, where people can give loan. Typically, it's going to be secondary loan to the project. Prior to the crash of 2008, the banks would give up to 100%, you know, loan to value. Today, it's way less. And those loans are only for what we call hard costs. So typically, that would be the construction material, the salaries to the construction workers. Every project has what we call soft costs. For example, marketing. You need to pay a city for the permits. The loan from the bank would not cover that. So you still need money to pay. And you either can bring more equity partners, which typically, the way we structure the equity partners would get paid more in the end. But you also can bring additional loan, typically a secondary position, that people can lend to the project.
Okay, okay. And with that, like, I know when it's a construction deal, right? You're not going to get the returns in the first year or something, right? Because like, with everything that is involved with the process. So how does that work for, let's say, investors, right? Is that like, hey, you're going to wait, 2-3 like delayed return for like a year or two, or 3 years, and then you get that massive chunk when the project is built or either sold, or when the rental income starts coming in from that. How does that process sort of work?
Yeah, you got it right. So normally you get paid on the exit from the project. So because it's a development deal, we estimate the time of the project from start to exit, and equity partners commit to that amount. With that being said, situations like COVID can occur, and so let's say city is closed, you cannot get permits for construction. So it's normal that in this environment you may experience delays. So the equity partners stay in the project until there's successful exit from it.
Yeah.
With loans, it's a loan, so there's beginning and the end. So developers or partners in the project take additional risk. So you do provisions for that. So for example, you can put in a note documents, you can ask for extensions that you got right for extensions. So just in times like today, if you need more time. But so loan has a beginning and the end, but the equity is typically the end of the project. This is where you get big chunk of the money.
Yeah, and that's for somebody like that's for, like, let's say somebody that maybe doesn't know about that. Like real estate, it's not as liquid as like stocks or anything like that, where you can buy something and sell it tomorrow. This is with real estate, you're like you're locked in for a year or 2 years until the project's sold, and then that return is made from that project, right? So it's not very liquid. But
that's why we tell people that if it's your last money, or the money you might need soon, please do not invest in the project. If you cannot commit to some period of time, this is not for you.
Yeah.
People should understand it.
So with your projects, do you guys have like a minimum amount that investors must put in, or do you guys take like different amounts? Like how is that sort of structured on your end?
With us, the entry point is typically $50,000. If it's in Canada, it's $50,000 Canadian. If it's US, $50,000 US. It's the amount that we found out over the years that people are comfortable. So we used to work with higher amounts, but it's people start losing sleep over that. $50,000. This is the way people think. So it's especially the beginners. Right? They think that things might go wrong, and they first of all they think about losing. So this is the conversation the person has in his mind. Okay, it's $50,000. If something goes wrong, this is what I'm going to lose, but I'm not going to lose everything. I can live with that. So this is the amount we found that most people are comfortable to start with. Now it's also much lower to start with compared to somebody who wants to buy real estate. Let's say even in Ottawa, let's say you want to buy a property, rental property. I don't know what's the average price today, but let's say $500,000. So just with 20% down payment, you need to bring $100,000 of your own money just for the down payment. So in our case, it's much lower. The entry point is much lower to participate in projects such like that.
Yeah, 100%. Yeah, like that's like, and the properties around here are pretty, like the in Ottawa, like it's probably the same for Toronto. They've just exploded in prices, right? It's like if you want to just get into like one property, just a single property, it's going to cost you like most likely over $100,000 to get into it, right? Whereas like for something such like, let's say they want to, and that also means too, is now you have to manage that property. You have to deal with tenants. You have to deal with everything that is involved with owning that real estate property. Whereas let's say if they decide to go off and invest into like a firm or something like such as your guys, they can invest a smaller amount and they don't have to deal with any of the, the problems of tenants and toilets and all that sort of stuff. And they can sort of just relax, wait the year or two, and then they get their money back, right? Or their money and their return back, right?
That's the idea. So, but it's different strategies. Some people like controlling things. So if somebody has to control giving money to somebody else, this is not for them. We know that, and we're not aiming to work with just every person on the planet. We're working with a selected group of people that are comfortable with what we do, understand what we do. And it's one side of the deal. If somebody has to control the money in the tenants.
Oh, okay. Awesome. So, Now I know we're coming to the end here. Where can people find out more about you, what you guys are doing, and sort of all that information?
Yeah, so the most simple way is simply to go to our website. It's www.cfpgroup.ca. If somebody wants to reach out to me directly, it's Michael at cfpgroup.ca. That's my email. We're also on social media, so you can type CFP Group on Facebook and on LinkedIn. But the most simple way is just simply to go to our website.
Okay, awesome. Well, so thank you again, Michael. It's been amazing having you on the show.
Absolutely. Thank you so much. Thank you.